Hello, I am Cem Oze. Welcome to the weekly Market Notes program. This week we are discussing critical developments shaping the financial markets. At the center of our agenda are the Federal Reserve's Fed interest rate decision and Chairman Powell's statements that have stirred the markets. Immediately after, we will look into the details of the surprise ceasefire between the two giants of global trade, the US and China, and what it means for the markets. On the technology front, we examine the AI-focused earnings reports of the giants, Nvidia's record-breaking performance, and the new dynamics driving the market. Of course, we will also provide a comprehensive analysis of how all these global developments are reflected in domestic markets, from Borsa Istanbul to the USD-TRY exchange rate. If you're ready, let's get started. This week, the markets were under the influence of two massive forces moving in almost opposite directions. On one side, there was a message that worried the markets despite the Federal Reserve's interest rate cut. Chairman Powell's speech was so impactful that the probability of a new rate cut in December suddenly dropped from over 90% to around 67%. This was the clearest sign that the expected reassurance was not coming. On the other side, a frenzy of artificial intelligence completely overshadowed these interest rate concerns. Supported by the positive atmosphere from US-China talks, tech giant Nvidia made history as the first company to reach a market value of $5 trillion. So, on one hand, interest rate worries, on the other, technological enthusiasm. How will these two opposing forces shape the market's direction? Let's look into the details. To understand the direction of global markets, we need to look at two main factors: central banks' monetary policies and the geopolitical moves of major powers. This week, both areas saw groundbreaking developments, leading to a reshaping of global risk appetite. First, let's examine the Fed's FOMC meeting decisions. In line with expectations, the benchmark interest rate was cut by 25 basis points, bringing it to the range of 3.75% to 4%. However, the real storm erupted during Chairman Powell's press conference. Powell repeatedly warned that there was no definitive outcome for the next rate cut in December, indicating disagreements within the committee. This uncertainty is the thing markets dislike the most. But there was also a positive surprise from the Fed. It was announced that the quantitative tightening (QT) program would be halted starting December 1st. What does this mean? Simply put, it means the Fed will stop withdrawing an average of $22 billion in liquidity from the market each month. This decision provides a structural support element for the markets in the long term. Another critical development of the week was the US-China trade talks. These negotiations are more of a ceasefire rather than a permanent solution. The most concrete step in the agreement was the US reducing the 20% tariff on fentanyl from China to 10%. This move lowered the total effective tariff rate applied to China by 10 percentage points, removing China from the list of countries with the highest customs tariffs. In response, China agreed to lift export restrictions on rare earth elements and to resume buying chips from the US. Looking at other central banks, we see that the European Central Bank and the Bank of Japan have kept interest rates unchanged. Although headline inflation in Europe has fallen to 2.1%, the core inflation rising to 2.4%, and service inflation reaching 3.4% indicate that sticky inflation risks persist. The Fed is essentially using the accelerator and brakes simultaneously. While lowering interest rates to support liquidity, it is also trying to curb expectations through verbal guidance. This situation, combined with data shortages that it likens to driving in foggy conditions, makes high market volatility until December seem inevitable. So, how does this global picture affect US indices? Let's look at the latest situation of the S&P 500. The S&P 500 index is like a barometer for measuring the overall health of the market. The current levels of the index contain important clues about investor psychology and the future of the economy. This week, despite being at peak levels, the index showed clear signs of fatigue. The index completed October with a 2.27% increase, continuing its uninterrupted rally for 6 months, and closed the week at 6,840.20 points. However, technical indicators suggest that this upward movement is beginning to lose momentum. First of all, the Relative Strength Index, RSI, is at 69, which is near the overbought zone. This generally indicates an increased likelihood of a correction. More importantly, there is a narrowing in market breadth. Just 3 days ago, 65% of the stocks in the index were above their 20-day moving average, but now this figure has dropped to 36%. This suggests that the rally is being driven by only a few large stocks and overall participation is weakening. Analysts note that the index has moved significantly away from its 200-day moving average, and a healthy correction towards the 6,100 to 6,200 levels is needed. To summarize the data related to the S&P 500, weekly close 6,840.20, October monthly return 2.27%, rise from April lows approximately 40%, technical support 6,680 20 gün moving average, technical resistance 6,900. Despite this fatigue in the S&P 500, technology stocks are practically writing their own story. Let's take a closer look at Nasdaq, which supports the market, and the artificial intelligence revolution. Nasdaq is no longer just a stock index, it is a compass that captures the pulse of the technological revolution and shows where the future economy is headed. The main driver of this week's rally can be summarized in one word: artificial intelligence. We can even understand how strong this theme is from Fed Chair Powell's words. Powell described AI investments as interest rate insensitive during the press conference and emphasized that the profitability of these companies is fundamentally different from the dot-com bubble of the 2000s. A new concept is now being discussed in the market: AI factory. These facilities are no longer just cost centers but have become efficient units that generate direct revenue and profit by producing tokens. We see this transformation clearly in the balance sheets of tech giants. Amazon surpassed expectations with a 20% increase in cloud revenues and closed the week with a jump between 9.6% and 10.8%. Microsoft. Despite the 39% massive growth in Azure, their announcement that they cannot meet demand created capacity concerns in the market, and shares reacted negatively. Meta. The plan to increase 2026 capital expenditures from $72 billion to $97 billion and a $15.9 billion tax payment pressured shares. Investors are questioning when high spending will turn into profit. Alphabet, Google, clearly demonstrated that AI investments are translating into tangible revenue, differentiating positively. Shares rose by 7.5%. There is a clear divergence in the market. Investors are now rewarding not just those who tell the AI story, but those who can turn this story into profit on their balance sheets. Google and Nvidia are the clearest examples. In an environment where the top 10 companies of the S&P 500 make up more than 35% of the index, the performance of these few giants determines the fate of the entire market. So, how has this enthusiasm in the stock market resonated in the bond market, which is the most sensitive barometer of the economy? Bond yields are one of the most important signals about the future of the economy. The shape of the yield curve reflects market expectations for growth and inflation. This week, the bond market responded to the Fed decision with a much more cautious reaction than the stock market. After the Fed meeting, the 10-year bond yields rose above 4%, increasing by about 10 basis points. However, the most significant movement occurred in the 2-year bond yield, which is more sensitive to short-term policy. Here, we saw an 11 basis point increase. This situation caused a movement called flattening in the yield curve. In other words, short-term interest rates increased more than long-term rates. The implication is this: the market is pricing in the risk of the Fed making a policy mistake. Investors are worried that the Fed might either ignore inflation or slow down the economy too much. In the upcoming period, one of the most important risk indicators for the markets will be the yields on 10-year bonds. The risk that the Fed may have to start a new asset purchase program, QE, in the future due to increasing budget deficits and political pressures remains on the bond market's agenda. The bond market does not share the enthusiasm of the stock market. On the contrary, it prices in an increased risk of policy errors following Powell and concerns about long-term growth. This divergence will be the most critical agenda item in the coming months. This cautious signal from the bond market makes it more meaningful why the rally in the S&P 500 has been driven by only a few tech giants and indicates overall market fatigue. To see how these changes in risk perception are reflected in commodity markets, let's now move on to gold and silver. Commodities play a dual role in markets. They serve as both a safe haven during geopolitical uncertainties and a barometer of economic strength. This week, gold and silver clearly demonstrated this dual identity. Let's start with the gold market. The precious metal has achieved a remarkable 51% gain so far this year, surpassing $4,000 per ounce, a historic achievement. However, Powell's hawkish remarks ended the party early. A strengthening dollar and rising real interest rates forced gold into a sharp retreat from the $4,010 level. Technically, gold has broken its short-term uptrend. According to analysts, it will remain under selling pressure unless it can decisively break above $4,200. Silver painted a more complex picture. With optimism about the US-China trade agreement, it retreated to near 47.30 at the beginning of the week, because unlike gold, silver is also an important industrial metal, and the normalization of trade reduces its safe haven demand. However, it showed a strong recovery by closing the week at $48.65. Technically, as long as it remains below the neckline at $50.71, the risk of a head and shoulders pattern targeting $46 remains on the table. Gold once again demonstrated how sensitive it is to the Fed's statements. Staying above $4,000 depends entirely on the market being convinced that interest rate cuts will continue. Silver, on the other hand, is caught between industrial demand and its safe haven identity. Let's move from traditional safe havens to digital safe havens, namely cryptocurrencies. Crypt assets have recently gained an interesting position as both a risky investment tool and a high beta safe haven amid geopolitical uncertainties. This week, we clearly observed the volatility brought by this dual nature. Bitcoin approached $126,000 with a 33% increase in October, trading near all-time highs. Institutional interest and geopolitical tensions supported this rally. However, the Fed decision created an almost shockwave in the market. Within just 24 hours after the decision, over $700 million in leveraged positions were liquidated. This highlights how sensitive the market is to monetary policy news due to excessive leverage usage. From a technical perspective, the main defense line for the bulls is at the $110,000 level. As long as this level is maintained, the medium-term upward expectation continues. In the short term, $117,250 emerges as a critical support point. Ethereum showed a parallel movement with Bitcoin and entered a consolidation phase around $3,150. Technical indicators are currently mixed and give a neutral signal. The crypto market received a harsh lesson from the Fed. Although the rise driven by institutional interest is structural, the fragility created by leveraged trading continues. The $110,000 level will indicate how serious the bulls are for the next leg of this rally. Now, let's turn to the domestic markets to examine how this turbulence in global markets reflects on Turkey. When assessing the overall outlook of the Turkish economy, foreign capital flows and the central bank's reserve levels are of vital importance. These two indicators show how resilient the economy is against external shocks. This week, the Treasury took a significant step in its external borrowing efforts. A successful Eurobond issuance of $2.25 billion was carried out. As a result, this year's total external borrowing exceeded the target of $11 billion, reaching $13 billion. This borrowing was necessary because Turkey has an external debt schedule of $9.2 billion to meet in the next 4 months. The central bank's position in the foreign exchange market is also noteworthy. According to calculations, from the beginning of September to October 28th, the market was supplied with $16 billion in foreign exchange, excluding gold price effects. The fact that last week's supply, excluding gold, was $8.7 billion indicates that the reserve accumulation process has reversed and that the effort to manage exchange rate pressures has increased. While the Treasury manages its schedule with successful borrowing on one hand, on the other hand, the central bank's substantial foreign exchange supply demonstrates its effort to manage the pressure on the exchange rate. A scenario where global liquidity becomes abundant again is critically important for markets like Turkey. So, how does this macro outlook reflect on Borsa Istanbul? Let's analyze the BIST 100 index. To accurately assess the performance of the BIST 100 index, it is necessary to look at both TL and dollar-based charts together, because foreign investors prioritize dollar-based returns in their decisions. The index finished the week at 10,137.30 points. experiencing a limited weekly decline of 0.15%. However, the banking index's increase of 0.62% and the industrial index's increase of 0.65% stood out positively. The technical outlook, however, presents conflicting signals. While short-term indicators show a negative picture, a very important development occurred in the medium to long term. The 50-day and 200-day moving averages formed a golden cross for the first time after 2 years. This is generally interpreted as a promising signal indicating the beginning of a medium to long-term upward trend. However, when viewed in dollar terms, we see that the index has been in a downward trend since July 2025. In this chart, the $270 level is a critical resistance and $247 is an important support. To summarize the data related to BIST 100, weekly close 10,137.30, weekly change 0.15%, critical resistance, try 11,290, critical resistance, $270, critical support, $247. Let's move on to our final data set to complete the picture of Turkey's markets within the triangle of exchange rates, interest rates, and risk premium. To understand a country's financial health, it is necessary to read the exchange rate, interest rate, and risk premium (CDS) indicators as a whole. These three reflect the risk perception of both local and foreign investors. The USD tri-exchange rate closed the week at 42.04. Powell's hawkish rhetoric strengthened the dollar index globally, creating short-term pressure on the exchange rate. However, in the long term, the Fed's decision to end QT is creating a positive environment for emerging markets like Turkey. Looking at Turkey's Treasury bond yields, we see that the 2-year bond yield is at 40.28% and the 5-year bond yield is at 33.62%. Turkey's 5-year CDS premium, known as the risk premium, closed the week at 245.79 basis points. This level, being close to the 52-week lows compared to the peak of 370.62, is quite significant. It indicates that the risk perception towards Turkey among foreign investors remains manageable thanks to the orthodox policy measures taken. The fact that the CDS premium remains low is our biggest advantage. It shows that the external market still credits the orthodox policy steps. However, if global winds turn against us, we will test how resilient this peg remains. In light of all these analyses, let's move on to the economic calendar to see which data will determine the market direction in the coming week. The economic calendar serves as a roadmap for investors. The data to be announced and the expectations related to this data play a key role in determining the direction of market movements. Let's not forget that expectations are just as important for markets as the data itself. Next week's agenda is quite busy. On Monday in Turkey, October, CPI inflation will be announced. Expectations are for a monthly increase of 2.9% and an annual increase of 33.4%, a figure above expectations could put pressure on TL assets. Throughout the week, the high-importance manufacturing PMI, which indicates whether the momentum in economic activity continues, will be closely watched. The medium-importance real effective exchange rate and current account balance dynamics, which will provide important signals regarding the competitiveness of the TL, and the high-importance temporary foreign trade deficit data, which are crucial for foreign exchange needs, will also be monitored closely. In global markets, the high-importance October growth data, which will play a critical role in determining the course of global recession concerns, will be followed throughout the week. Don't forget to subscribe to our channel and like our videos to stay informed about market developments. See you next week. I wish you a profitable week.